Ivory, I note that you say you think the Fed will move because inflation is peaking. That seems counterintuitive. If inflation is peaking, why does the Fed need to move?
Well, some of this is window dressing as well. You know, a lot of middle-class Americans are having an issue going to the grocery store and filling up their gas pump. I do think that inflation has peaked. If you look at the 2-year yield and the 10-year yield, it's hitting lower highs. Look at the MOVE index. It's actually going down. So the market is telling us that inflation has kind of peaked. That same thing with the CRB index, oil, natural gas. The market is telling us that we've pretty much hit the peak of inflation.
I believe I asked someone, maybe it was Bob Pisani yesterday, why is the stock market, maybe the day before, why does the stock market seem so unimpressed with these high inflation numbers? And he said the same thing. They're thinking that inflation has peaked. And that's why they're looking ahead. Do you agree?
I do. In the third quarter, we had the opposite effect, where growth was slowing and inflation was rising. But as the data has come in and showed hot reads that were, in fact, in place in Q3, that is starting to ameliorate. So we're seeing growth accelerate, and that's a good thing. So if there's inflation and growth, markets can deal with it. And I think that's what we're seeing. That's why I think markets and the bond yields are saying the same thing.
So the consensus here is that the Fed is likely to accelerate its taper by double, going from 15 billion a month to 30 billion, and that it may signal higher interest rates. If that is what turns out to be the case, what should I do about my investments? How should I change how my portfolio is structured?
Well, most people shouldn't change their portfolios based on what the Fed may or may not do at any 1 month's time. I think that's the most important thing. But let's talk about what 2022 might look like. If there is inflation, then you're going to want to have portfolio stocks that has pricing power, things like Broadcom or things like United Healthcare. Companies that can pass along those costs to their end users. If you can, Microsoft, I mean, there's a lot of companies that have those characteristics. If there isn't inflation, it's basically the same thing we've been doing for the last couple of years. It's all tech.
So same question to you, Ivory. If we get that consensus view, right, what would you be doing within your portfolio? And then I want you to address something that you raised off mic just a few moments ago, and that is the possibility of what happens to the Fed's balance sheet down the road as bonds in their portfolio mature. If they don't replace them, that's money coming out of the system.
Yeah, exactly. So think about what we've been doing over the last 12 months. We've been having inflation hedges inside the portfolio. So that looks like energy. There's been commodities inside the portfolios. If we start to see inflation decelerate, you know, the second derivative on a rate of change basis start to go down, then you want to have things that you want to get rid of those energy stocks and the commodities, and then you might buy some tech because we're still going to have some growth. Now, to your point about the balance sheet, we've got a $9 trillion balance sheet on the Fed. If that starts to decline because they don't replace the bonds as they mature, that brings into play, does the GDP start to decelerate as well? That's a completely different setup. Then you're not buying tech stocks. Then you're buying utilities. You're buying real estate investment trusts, consumer staples, a much more defensive portfolio when growth and inflation are both going down at the same time.
But that's something to watch for when? 2022, 2023 on the balance sheet?
That's correct. We wouldn't see that until 2022.
2022. All right, so we talked about what the consensus possibility is here, the quicker tapering, the possibility of sooner and more interest rate. What could be the unexpected tail risk to come out of the Fed today? What might it be, and how would that change what you just told us your investment thesis would be?
I think that the only thing that could happen, I think the statement isn't going to give you any tailwind problems. I think in the press conference, when words are misinterpreted, markets could find something that suggests that inflation is higher and the Fed is going to accelerate its pace of rate cuts or rate increases, for example. That could be misconstrued. I think that's the area in which there might be some tail risk, but I believe the Fed's going to be much more dovish. I don't think they're going to be as hawkish as people think, because there's no reason for them to be.
Shepard Smith here. Thanks for watching CNBC on YouTube.